I was planning on talking about crop insurance a little bit more. I'm going to talk a little bit about it, but given some of the recent events, I thought it would be prudent just to kind of give a quick overview of some of the developments we've seen in terms of tariffs. And so most of you that follow the news probably are aware of this, but the U.S. increased tariffs on China 10% in February, an additional 10% in March, and then implemented 25% tariffs on Canada and Mexico, with an exclusion for Canadian energy of only a 10% tariff. Immediately following that, China instituted retaliatory tariffs that targeted agricultural products. And so 10% tariffs on sorghum, soybeans, pork, beef, seafood, fruit, vegetables, and dairy, and then 15% on chicken, wheat, corn, and cotton. Canada announced 25% reciprocal tariffs that will be imposed on just over $100 billion of American goods. There's several ag categories in there. We are looking at it by HS code, which is just an import code. It's just a little messy to end up going through that. But there's several ag commodities on there, and ag related products such as distilled spirits. So obviously there's going to be some potential ramifications there. Mexico has not responded yet, but they said that they will announce their formal response on Sunday. And so when we look at this, there's obviously a high degree of uncertainty, but when we look at U.S. Mexico agriculture trade, you can see on this graphic here where we've got U.S. ag exports to Mexico and then U.S. ag imports from Mexico. You can see which potential commodities would end up being affected. I'm going to focus more on talking in more depth about kind of corn, soybeans, cotton, and wheat. But obviously, this has ramifications potentially for not just producers, but also on the consumer side of things when we look at some of the products that are coming across the border. Similarly, when we look at total U.S. Canada agriculture and food trade is just over $72 billion, with 32 billion in exports to Canada and 40.5 billion coming in from Canada. You can see the broad categories that may potentially be affected. And there was actually some estimates in terms of Tennessee ag exports to Canada of 307 million and imports of 475 million dollars. So when we look at this, it has the potential to obviously affect several different sectors of the economy. When we look at corn, cotton, soybeans, and wheat in particular, below this table, that percent of 2024 U.S. production projected to be exported to all countries, 16% of corn, 41% of soybeans, 43% of wheat, and 76% of cotton produced in 2024 is scheduled to be exported. When we look at the importance of Canada, Mexico, and China, those three countries for corn, cotton, soybeans, and wheat represent 53% of that total below for corn, and then 31% for cotton, 62% for soybeans, and wheat at 24%. Now, again, when we look at this, there's still a tremendous amount of uncertainty as to what this is going to end up looking like. It matters what the duration of these tariffs are. It matters if there's escalation. There will be some rerouting of supply chains. But for the time being, obviously, we've seen prices drop dramatically. Not all of the recent price drops are due to tariff activity. There's a bunch of it that's due to other factors. Increased price volatility and uncertainty is pretty much a given when we look at the uncertain nature of the policy environment related to tariffs. We could see potentially elevated input prices, and the two that I think will be interesting to watch is potash and oil and gas. About 85% of U.S. potash comes out of Canada. Other areas that have large amounts of potash, such as Russia, obviously have other challenges. And so again, that could be potentially something that would increase the production costs longer term, right? The one thing you have to remember is for most of the potash that's going to be used this production season, it's already in the U.S. And so there could be a lag to this. Or if we end up seeing a resolution to these tariffs, obviously then that impact may not be felt as strongly. Tariffs typically will increase those costs to consumers, and long term it could potentially shift supply chains when we end up looking at long-term ramifications. The one thing that does concern me, particularly when we talk about our four primary row crops, is what happened with the last trade war with China in particular, but it's the potential for further loss of market share to Brazil. When we look at this graphic on the right hand side of the screen, it shows China's agricultural imports in 2015 and 2024, and you can see that U.S. section we have recovered in terms of dollar amount what we were importing before the first trade war. But the problem is we haven't grown the percentage of the pie, and that's these top two bars, right? If we look at the U.S. section and then use Brazil as the counterweight, you can see that share has increased dramatically, but the U.S. has not been able to capture that, and that is something that is potentially another longer term ramification of extended trade war. And so again, we'll have to see how this continues to materialize over time. Obviously a resolution could provide, a pathway to additional exports to some of these countries that would be beneficial for prices. So we will have to wait and see, but in the short term, we're looking at a lower price environment and probably increased volatility and uncertainty as we move forward. So we kind of look at what markets have done. I want to break it down into old crop and new crop and talk a little bit about the price action that we've seen recently. Just as a reminder for anybody that's seen me in person throughout the winter meeting season, this will not be a new slide, but I really do think that we need to focus on managing our cash prices in two components, futures price and basis. And that applies to both old and new crop. Looking for beneficial opportunities to secure a good basis price. If you are in the eastern portion of the state or the southern middle portion of the state, there's been some very, very good basis offerings. And so again, making sure that we're taking advantage of those, I think, is incredibly important. Futures are going to be a little bit more challenging. I hope people got a price floor on the future side sometime in January or February because an immediate snapback to where we were seems very unlikely given where we're at right now. And so again, we're looking at those basis opportunities. I mentioned this several times, but we need four things to take advantage of that. We have to have the production. That was a challenge in many of our counties just because of drought that reduced what we ended up having in terms of yield. You need that storage capacity, and then you have to have the ability to transport corn or soybeans to that market. And you have to be aware of when these companies need market access. So or need corn to come from the producer. So for example, if you have Tyson in your area, they need to know that you have corn in storage so that if they get in a pinch, they can call you and say, we need 50,000 bushels. Can you deliver it here? And hopefully you can get a very beneficial basis to end up fulfilling that. But we need those four things to take advantage of these opportunities. I've mentioned the returns to storage over 10-year intervals. I updated this with the most recent information, but essentially what we're looking at, this has corn on the left-hand side, soybeans on the right-hand side. When we end up looking at this, if we avoid that harvest low and we carry corn, and this is cash price, from September until March, on average over the previous 10 years, we would gain 77 cents per bushel. So again, when we're thinking or talking about investment in storage infrastructure, I know margins are tight and it's challenging to make that type of investment, but for both corn and soybeans, long-term, we have seen a return to storage. This does not include any costs, but again, when we're talking 77 cents per bushel per year, I think it's something where it should at the very least be investigated if it's a solution for different farms. What are the futures markets telling us? I updated these as of close of business yesterday. And so when we look at this, what we've seen prices come down pretty dramatically from the highs. But what we're looking at is kind of those two different segments, right? We have the old crop, which would be the May, July contracts. When we look at corn, cotton, and soybeans, and then when the July contract would be the new harvest contract for wheat. So we have to distinguish between which crop we're marketing and what the price is that we're looking to secure on the future side. For how long are you willing to store old crop? I know a lot of people hopefully took advantage of that corn rally and some very beneficial basis opportunities. I worry that we could see, some continued weakness in the future side of things in terms of basis. I think basis will remain reasonably strong just because of the shortness of the crop, particularly in the southern portion or southern eastern portion of the state. When we look at old crop prices, this is where you can't attribute all of this to tariffs. Obviously, tariffs play a role, but when we end up looking at old crop, there's been some substantial changes. First, I do want to quickly just talk about crop insurance because it has changed kind of the risk that we've seen. The crop insurance prices for our three primary crops have been set. The price determination period for corn, cotton, and soybeans is February 1st to February 28th. So these will be the prices for revenue protection policies. We have 470 for corn, which is actually up a little bit from last year. There's 466. Cotton is at 69 cents compared to 83 cents last year. And soybeans is down over a dollar at 10.54. So it does change the relative level of risk between commodities. Or if you're looking at corn's going to be similar to last year, where cotton and soybeans, the protection that if you use the same buy-up coverage is going to be substantially less when you look at a revenue guarantee per acre. The other one that is coming up very quickly is our ARC and PLC enrollment. Deadline is March 25th or March 15th for the 2025 crop. These are the payments that are made on base acres, not planted acres. So it really does matter what your base acres are. When we look at this, that some of this has changed. A lot of it is going to be contingent on what your expectation long term is for prices, in terms of what the enrollment's going to be. If you are interested in where you're at for individual counties, you can reach out to me. I've provided some estimates based on current information that can help guide those decisions. Switch it up to where we are in terms of nearby corn futures. So for the old crop, you can see on the far right-hand side, it has not been a good couple of weeks on corn markets. We peaked up around that 520 mark, and we've shed about 70 cents over the last 7 trading days. Some of that is due to tariffs. A big chunk of that is due to improved weather down in South America. And then a lot of this is also being partially attributed to liquidation of fund positions, so it can amplify that move. And you see this pretty consistently. Soybeans, again, we've seen that drop off dramatically. This can be, again, I think more attributed to the trade side of things just because of the importance of trade. Wheat was hit very hard as well. When we end up looking at this, we actually set a new contract low on wheat. And then on cotton futures, down around 63 cents. So again, a very bullish or bearish couple of weeks for our primary row crop commodities. And so again, hopefully most producers were able to take advantage of some of those elevated prices last month, where they were able to lock in a futures price or at least get a floor underneath it. When we switch it up to the new crop, when we start looking at where we're at, I think one thing that we do have on our side is time. Obviously, we haven't even started planting this crop, but I do think now's the time to really emphasize to producers how do they deal with risk management now that we have crop insurance prices set. There's a huge difference if a farmer has access to storage versus non-storage as to how aggressive they want to be in managing their price risk. And so when you're looking at no storage, I think we need to be a lot more aggressive during the production season because we do want to avoid that seasonal harvest low. And so again, looking at getting some type of price protection, and you can do that through multiple ways. You can use a cash forward contract. You can use other contracts like a hedge to arrive where you lock in a futures price. You can use a basis contract. It's going to vary depending on which part of the state you're in. One of the ones that I was talking extensively out in West Tennessee is, the uncertainty that's embedded in basis because of the Mississippi River flow, right? And so if you look at basis and say it's even 10 under, just for hypothetical, you can't store if you don't have access to storage. If it's 10 under, 10 under is not as bad as if we end up getting that low basis as a result of the river where we can get 80 under the board, right? And so how we manage that does make a difference as to whether we can store or whether we have to end up sending it to market when we get there. When we look at if we do have storage, I think we can be a lot more patient. I think we can wait out, look for market opportunities. If we see a rally, I think we can start looking at potentially incrementally pricing into that rally, just so that we're not pricing all at one point in time. I've made the analogy several times. You won't necessarily hit a home run with that strategy, but you will avoid that strikeout when we see the potential decline in that market. The one that I think you both have to be very cognizant of when we're looking at new crop pricing is we really have to be careful that we're not overpricing, right? We don't want to end up exchanging price risk for production risk where we may have not enough crop to end up marketing once we end up getting to the harvest. When we look at where we're at, again, we've seen that we're kind of down from where we were in terms of our highest prices. Most people think that we are entering a period of where we're probably going to see lower prices. The volatility is something that I think will probably be lower, but again, the tariffs add a factor there that is very unpredictable. You could end up seeing, again, if we've seen large purchases negotiated, you could see a rise in prices, right? So there's a high degree of uncertainty on the new crop. So I think there's kind of a wait and see attitude right now in terms of where we are. When we look at corn prices, this is the average for the December contract. We're obviously about 20 cents lower than that right now, as prices have come down. When we look at soybeans, 10.43, we're down closer to that $10 mark right now when we end up looking at where prices are. But we end up seeing, is there opportunities to price? There's better opportunities about a month ago or a couple weeks ago. So again, I think there's probably patience is probably the best strategy when we're talking about the new crop. Cotton's a real challenging one right now when we look at where prices are. There's not a lot of indication that we will be able to get back up in that mid 70-cent range where people might start taking some risk off the table. I think we're going to kind of be marred in that lower 70s to upper 60s for a while now. When we look at futures price ranges in terms of what we're looking at, I've had to update these compared to some of the talks I've gotten just because of the tariffs that we've seen. We've seen the bottom of this market extended a little bit lower, and we've seen the top kind of taken off this market, particularly on the old crop, where I think the short-term uncertainty, if we look at between now and say even July, I don't think we will be able to get up to that 540 range on corn. Just because of the uncertainty that's embedded in the short term. On the new crop side of things, I still think there's the opportunity on the upside. But again, I think we need to be patient in terms of how we deal with risk. The number one thing that I encourage people to look at or encourage farms to look at right now is getting the most out of their crop insurance as possible. And that involves looking at how much coverage we buy up, what our unit structure looks like. So are we using basic, optional, or enterprise units? And then is there a companion policy such as SCO, ECO, or the margin policy that it can be beneficial to producers? If anybody wants more additional information on that, they can definitely reach out to me. But the crop insurance decisions this year, I think, will be very important. We want to make sure we're getting the most protection for our premium dollars out there. So when we look at kind of what we're looking at, we need to make all our decisions based on well thought out analysis and risk preferences. You don't want to be just wishing and hoping. What we want to have is a strategy that we manage our price risk effectively, both for the crop and storage and the new crop. You have to, when you execute a strategy, you have to be comfortable with the potential range of outcomes. The market's not always going to move in the direction that you think it is. I think we need to be cognizant that there's a range of outcomes that can end up occurring. And we have to be comfortable with those before we end up making that decision. And then as we move through the year, look at the successes and failures from the strategy employed and why or why not did we get the result that we ended up getting. And so again, I think just because of the amount of uncertainty that's embedded in markets, I think it's very important to to kind of make sure that you have flexibility. I wouldn't rush into any strategies on the new side. If you still have crop in the bin, I'd look for more for the beneficial basis right now. I think obviously there's some good basis opportunities, but again, there's just a lot of uncertainty when we look at futures prices based on where we are right now.